Hi everyone, I'm Bruno Santos, Market Intelligence Specialist here in StoneX. Let's talk about what's happening in the oil market right now, because the last few weeks have been anything but calm. The whole move really started with the memorandum of understanding signed by Washington and Tehran in mid-June. While that agreement held, it took a lot of risk premium out of the market, and by early July, Brent had fallen to its lowest level since mid-February. But once the White House announced the end of the MOU, everything flipped. Hostilities between the US and Iran resumed in the Persian Gulf. New blockades hit Strait of Hormuz and Bab el Mandeb, and Brent shot up to touch the $100 mark in mid-July. Since then, with both Washington and Tehran suspending further attacks over the weekend, part of their risk premium has melted away, and prices are now trading back around $85 a barrel. And there's one tension worth flagging right out at the outset. We have started to hear rumors of diplomatic progress with talks of renewed negotiations between the parties. However, it's important to address that fiscal flows through the key straits remain deeply depressed, and we haven't seen any real recovery in the tanker data yet. The headline story is that the Strait of Hormuz, which is the single most important energy corridor in the world, has effectively closed again. And the maritime data is striking. Tanker data crossing collapsed from around 50 vessels a day back in January and February to just 1 to 4 by late July. The US blockade further squeezed Iranian exports, and even Saudi, Iraqi, and Emirati cargoes started facing bigger logistical hurdles. So the market is no longer pricing just geopolitical risk, but it's also pricing physical supply risk. In flow terms, Hormuz went from about 20 million barrels a day pre-war to roughly 3 million barrels a day today. And with global inventories already low, any additional disruption can widen the deficit very fast. On top of Hormuz, we now have a second pressure point, the Strait of Bab el Mandeb in the Red Sea. Houthi attacks on Saudi vessels have put this route in the spotlight. It normally carries around 9 to 10 million barrels a day, but roughly 4 to 4.5 million are now at risk. Saudi Arabia has been leaning on the port of Yanbu as an alternative since the beginning of the war in the Middle East, shipping most of its barrels through the Bab el Mandeb canal to Asia. But if both corridors are constricted at the same time, global logistical flexibility drops dramatically. Higher freight, delayed deliveries, and a deeper physical deficit in refined products may be seen over the next weeks. Asia is the most exposed region here because these flows can't easily be rerouted. The Suez Canal, for example, can't handle VLCCs and is really oriented toward Europe. To redirect cargoes through Suez, ships have to go around the Cape of Good Hope, and that adds a full extra month to delivery times for the Asian market. For supply timing, that's a massive difference. And the country that feels this most directly is China. After hitting its lowest crude oil imports in almost a decade, China started buying again as Hormuz briefly reopened. But here's the key dynamic. With the strait closing once more, China has been leaning on the large inventories it built up through 2025, pulling back again on foreign purchase. That restraint is actually one of the main reasons prices haven't run even higher in the recent months. The flip side, as those reserves shrink, China will have to return to the market, increasingly for heavier crudes from alternative sources. We expect a more present, more active China in the second half of the year, and as it comes back, it will absorb a good chunk of the supply that is available today. That makes Chinese buying one of the single biggest swing factors for prices going forward. Now, looking at the United States, commercial crude stocks recovered a bit in July, mostly on lower early month exports. Domestic demand stays strong, and the US remains the world's supplier of last resort, but with shrinking room to maneuver. The concerning part is that the strategic petroleum reserve keeps falling, and total US petroleum stocks just hit their lowest level since 1984. One quick offset to watch is the Atlantic hurricane season. A strong El Nino is suppressing storms, and we forecasters seeing only about 9 to 11 named storms, which is below the historical average. But the Gulf of Mexico is roughly 14% of US production, so a single major storms like Ida in 2021, which took about 1.7 million barrels a day offline for nearly a month of production, could still reverse the recent relief. Finally, refining margins. Diesel and gasoline crack spreads have hit their highest level since 2022, with the heating oil crack pushing toward $85 a barrel. Product inventories are below historical averages across the US, Europe, and Asia, and the ban on Russian exports plus weaker Chinese and Indian shipments are tightening things further. So the key takeaway is that the tightness isn't just in crude, it's especially in refined products and above all in diesel. For importing markets like Brazil, actually the main risk right now is not necessarily a shortage but higher costs. Thanks for watching StoneX TV. I wish you all a great week.